So what can you do when you just can't scrape together your deposit? Sure, you can spend another year saving and continue to pay rent, or you can consider using a guarantor to help you achieve your home ownership goals faster. The easiest way around the deposit dilemma is to garner the support of your parents or close family members who already have a considerable amount of equity in their own home, who may be willing to support you by guaranteeing your loan. In other words, you'll need someone to go guarantor for you. Essentially, a guarantor is a close family relative, usually your parents, who has either paid off their own home or has a significant amount of equity in it. They must be willing to put that home up as security against your loan and agree to cover your loan repayments if you default. Most lenders offer guarantor loan products for first home buyers, although they go by different names. Depending on the financial institution, terms you might hear that refer to these type of arrangements include family pledge loan, family support loan, family equity loan, fast track loan, family guarantee loans. Guarantor loans have many benefits for the borrowers. For example, it helps you get into the housing market more quickly. Also, you can borrow the money to cover your deposit if you don't have enough savings. With a guarantor, you may be able to borrow 100% of the cost of the purchase, and it also helps you avoid paying mortgage lenders' insurance. The main risk for the borrower is that they may be enabled by the guarantor to take on a much larger debt than they can really afford. The guarantor, however, faces a number of risks. For example, they're going to be the ones agreeing to put up all or part of the equity that they have in their own home as security for you. Plus, they may have to cover your loan repayments if your circumstances change. And the biggest risk of all is that they may need the money back for an unseen change in their own personal circumstances before you're actually able to repay the funds. While going guarantor can be risky, there are ways to minimise that risk. The amount of equity offered as security doesn't have to be 100%. It can be limited to an amount that equals the deposit required by the bank. This means that you can go ahead and borrow at 95% LVR or less, and the guarantor security arrangement will cover the other 5% or more. Once you've repaid an amount equal to the guarantee, the guarantor can be released from their obligation to cover your payments pending approval from the lender. Another downside of applying for a guarantor loan is that the approval process can be quite lengthy. The lender will need to assess the value of the security being offered and the financial status of the guarantor.